Hi there, and welcome to the GSMC Business Podcast, brought to you by Golden State Media Concepts. I'm your host, Farrar. Thanks for joining me. It's Wednesday, December 11th, 2019, and coming up, we'll get the numbers from Wall Street, a breakdown of today's statement from the Federal Reserve, two oil-related stories, one, Saudi Aramco's $2 trillion IPO, and two, why Chevron's latest write-down could cost the entire market. Also coming up, why iBuyers are making housing analysts nervous, new spin-offs in the world of fast casual dining and desserts, a surprising increase in consumer prices, and how Asian markets are doing in advance of Sunday's tariff announcement from the White House. Plus, a company in Maryland has handed out $10 billion in end-of-year bonuses. What does that mean for tax purposes? It's all coming up in the next 60 minutes right here on the GSMC Business Podcast. First, the market news from Wall Street. Yesterday closed essentially flat. The Nasdaq was up 0.8% to close just over 86.29. The S&P 500 up just 0.3%. It finished just under 3137. The Dow Jones Industrial Average finished the day at about 27,925. That's a gain of 0.6%. The yield on the 10-year T-note was up 1.8. It now stands at 1.839%. Gold was up about 0.33% to land at $14.69.70 on the day, and oil closed at $59.32 a barrel after a gain of just over 0.5%. Speaking of oil, you may have heard about the largest initial public offering ever. It was that of Saudi Aramco, the most profitable company on the planet. In 2018, Aramco pulled in a net profit of $111.1 billion. No surprise then that Aramco is now the world's largest listed company, having opened up 1.5% to the market. The state-owned company, whose official name, by the way, is the Saudi Arabian Oil Company, NACH, maxed out its IPO price yesterday at 10% above the opening ask. Trading started at 32 Saudi riyals and rose to 35.2. That's about $9.38 per share. That put the company's offering the biggest ever. The last record was set back in 2014 when Alibaba made $25 billion on its first day. Back in September, Aramco was the target of drone strikes. Two plants were attacked by Houthi rebels, forcing the company to cut production by almost 6 million barrels a day. That's over half the company's daily output and 5% of the supply for the entire world. Nonetheless, Aramco decided not to postpone their IPO. But how much of a win was this? It looks like a big plus for Saudi Crown Prince Mohammed bin Salman and his program to transform the Saudi economy, Vision 2030 as it's called. Bin Salman first proposed the IPO 3.5 years ago. Bloomberg News reports that Salman made investors nervous by claiming an IPO would bring a valuation of $2 trillion. Foreign investors were a little more modest. They said maybe $1.2 trillion. That's a 40% discrepancy. And before you think of buying shares in Aramco, you may want to consider what made them so cautious. Dividend yield. Even at that higher $2 trillion valuation, shareholders would get a return of less than 4% on their money. Other major oil companies like Shell, ExxonMobil, and Chevron pay well above 4% already. Banks advising Aramco's listing said that after a roadshow across the Middle East for the last several weeks, the local listing was oversubscribed. One of Aramco's advisors, Samba Capital, said that only 10.5% of offers came from foreign investors. Most of the rest came from funds, companies, and wealthy local families and billionaires already in Saudi Arabia. And is an IPO really the best strategy when oil prices are tumbling overall? On Monday, the Saudi government announced it projects a budget deficit for next year of $50 billion. That's $15 billion more than last year's deficit. The country has posted a deficit every year since a sudden drop in oil prices back in 2014. So how is privatizing 1.5% of Saudi's biggest oil producer going to help the Saudi economy if most of the money that bought those shares was already in the country to start with? Already, analysts are scrutinizing today's IPO to try to find the real value of Aramco. After all, the company was hoping to sell $100 billion of shares and only sold $26 billion. We won't know what those shares are really worth on the open market for another 6 months. As promised, here's our second oil-related story of the day. Chevron plans to cut funding to multiple natural gas projects in the U.S. and Canada. According to documents filed with the SEC Wednesday, Chevron is also writing down the value of a major deepwater drilling project in the Gulf of Mexico called Bigfoot. It seems America's abundance of crude oil and natural gas, which is good news for consumers, is causing Chevron to take this cut of between $10 billion and $11 billion. Wall Street wants to prevent another crash in crude prices, so it's pressuring oil companies to keep spending down, and Chevron is complying. The company says it plans to keep spending flat at $20 billion for the third year in a row. The shale oil revolution has made the U.S. the world's largest producer of oil and natural gas. Although it's good news for energy independence, it means companies like Chevron are tightening their belts and reducing their investment in new production. CNN quotes Chevron's CEO as saying that the company is investing in the highest return, lowest risk projects in their portfolio. But according to Howard Silverblatt of S&P Dow Jones Indices, a write-down this big from Chevron could reduce fourth quarter S&P earnings by $1.32 per share. That's the entire S&P 500 knocked down over $1 by one corporation. Chevron may be the second largest oil company in the U.S., but even with the spending flat, it is still very, very big. Coming up, no change from the Fed, followed by no change from the Fed? And is now a good time to invest in real estate? Details ahead, right after this.
Tired of searching the vast jungle of podcasts? Now listen close and hear this out. There's a podcast network that covers just about everything that you've been searching. Hey! The Golden State Media Concepts Podcast Network is here. Nothing less than a podcast bliss with endless hours of podcast coverage. From news, sports, music, fashion, cooking, entertainment, fantasy, football, and so much more. So stop lurking around and go straight out to the Golden State Media Concepts Podcast Network. Guaranteed to fill that podcast itch. Whatever it may be. Visit us at www.gsmcpodcast.com. Follow us on Facebook and Twitter and download us on iTunes, SoundCloud, and Google Play.
Welcome back to the GSMC Business Podcast. I'm Farrar Hutkins. Thanks for joining me. The Washington Post ran a piece today with the headline, 2019, the year the Federal Reserve admitted it was wrong. Sounds pretty dramatic. Fed policymakers made a unanimous decision to leave interest rates right where they are. Currently, banks borrow from each other at rates between 1.5% and 1.75%, and that's where they'll stay for the foreseeable future. The U.S. economic expansion is now in its 11th year, so I don't think anyone was expecting anything dramatic. The move certainly falls in line with market expectations. CNN reports that the Fed signaled plans to move into an extended pause, which is a way of saying we're going to wait and see. It could, however, be bad news for President Trump, who has been trying to needle Fed Chairman Jerome Powell into lowering rates, as had already been done 3 times this year. Trump says that other countries have lower interest rates than those in the U.S., and that as a consequence, those countries are experiencing faster economic growth. Markets had been in the red all day until Powell's announcement, after which they turned slightly up, as you heard at the beginning of today's podcast. And the Fed's updated projections indicate that the Fed may not move at all next year. Other predictions for 2020 include a 3.5% unemployment rate, which is where it was last month. That's a 50-year low, by the way. Chairman Powell said today that he'd want to see a steady rise in inflation before raising interest rates again. He also said it's been challenging to get inflation up to its 2% target. Although producer prices remain steady, U.S. consumer prices rose more than expected last month. The Consumer Price Index up 0.3% as gasoline prices rose. Economists had told Reuters they were expecting 0.2%. In addition to gasoline, food, rent, hotel and motel prices, healthcare and apparel prices all nudged up a bit. We'll get to the housing market in a minute, but here's the one exception to the list of rising consumer prices: auto sales. Not used auto sales, which also rose slightly, but new. Prices for new vehicles fell for the 5th month running. Automakers are offering big discounts to offload older models. So does that mean that now is a good time to buy a new car or truck? Well, remember the old buy more, save more commercials? It depends on what you want. Some of the more expensive vehicles are being discounted in the double digits. Lexus is offering a $10,000 off a 2019 LC500. That's almost 11% off the sticker price, unless you get the hybrid version, in which case it's only a $7,500 rebate. Photos have been leaked on the internet of the forthcoming new Cadillac Escalade, but you can pick up a 2019 model for $8,000 off MSRP. And get this, if your last vehicle was not from GM, you get a $3,000 bonus. A total of $11,000 off means a 14% discount. And if you were looking at the Jaguar XJ-V8, you can get up to $13,000 off. That's 13.8% off the starting price of $94,325 for that supercharged sedan. What about housing? If you want to know what the new home market is going to look like, check shares of home improvement stores. One company that is not planning on a good year next year is the Home Depot. The big box home improvement retailer just cut its earnings forecast for the second time this year, leading to a 2% drop in share price. That's in part because, according to their CEO, they keep being hit by organized theft. But it also seems the housing market is poised to slow down next year. Realtor.com's national forecast for 2020 says they expect price growth to flatten and mortgage rates to go up. So if you're planning to sell your house next year, you're going to have to be patient because it may not sell very quickly. And if you're planning to buy next year, good luck if you're a first-time home buyer because there's not going to be much in the way of entry-level housing. The luxury market is where it's at right now, and you're going to have to pay a little more to finance, too. But who's buying homes anyway? Some surprising news from MarketWatch, a subsidiary of Dow Jones. They're reporting a substantial increase in market share of iBuyers. No, that's not the latest trademark from Apple. It's a short way of saying companies that use technology to make instant offers on homes. Redfin, Zillow, OfferPad, and Opendoor are all examples of iBuyers. Redfin conducted an analysis of the market and found 18 major metropolitan areas where iBuyers have gained 1% or more of the market share. In Phoenix, Atlanta, and Charlotte, it was over 4%. Raleigh, North Carolina was 6.8% compared to just 3.8% a year ago. iBuyers focus on homes at the lower end of the market, and some research has shown that people who sell their homes earn less money than those who sell on the open market, up to 11% less. But they may be willing to trade making less money for the convenience of being able to sell right away. What's the drawback? Analytics. Last month, economist Joshua Shapiro wrote that with iBuyers taking more market share, the data coming from traditional home listing services will be less accurate and less useful. As iBuying continues to increase, if the information is less accurate, housing market forecasts may also become less accurate. Some experts are saying that volatility is fast becoming the new normal in the stock market, but if the housing market becomes regularly volatile, well, we'll just have to wait and see. Coming up, President Trump is expected to make another announcement about tariffs on Sunday, and Asian markets are watching very carefully. Plus, what kind of year-end gift giving is best for business? Straight ahead here on the GSMC Business Podcast. Stay tuned.